Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. In today's video, we're going to talk about the three major catalysts that could cause the US stock market head to a market correction and how to prepare for it. Specifically, I will talk about what I will be doing going forward to prepare for a market correction. Before talking about the three major market correction catalysts, I will give you a quick update about one of my growth stock portfolios here. 3.5 months ago when I made this video, it was at 530,000. Now it's at 620,000. I will talk about the strategy I used to grow this stock portfolio consistently over time. Now, if you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the stocks I'm buying for the long term, watch our exclusive investing tutorial videos, and download the latest intrinsic value calculators so you will know when a stock is currently overvalued, fairly valued, or undervalued. The link is in the video description. Take a look. Let's start. I always believe anyone can do very well investing in stocks if we have the right strategy and if we invest in the right stocks and ETFs. Also, I believe anyone can grow their stock portfolios to over 1 million if we consistently invest in the best stocks and best ETFs without leveraging and without speculating. I believe having the right strategy is most important when it comes to investing in stocks, investing in ETFs, and growing our stock portfolios over time. 3.5 months ago when I made this video, this growth stock portfolio was at 530,000. Now it's at 625,000. The total gain including additional contribution is $95,079.5. I contributed $11,457.78 to this portfolio. This means the total gain excluding contribution is $83,621.72 during this period. Now this portfolio grew 15.78% during this period, excluding the contribution here. In comparison, the S&P 500 index grew 4.76% during the same period. I always use the S&P 500 to measure my portfolio because I always try to beat the S&P 500 index consistently over time by investing in the best businesses that have increasing earnings and increasing economic modes. If you have been following my stock analysis videos, you will notice that I always focus on finding the best tech stocks that have great earnings growth and great economic modes that can protect their businesses from competition. Now you may wonder, what is the strategy for this growth stock portfolio? The strategy is very simple. I always mention it in many videos. To beat the S&P 500 index, my strategy is to always invest in the best businesses that have increasing earnings and increasing economic modes. I specialize in analyzing and investing in tech stocks, so I will always try to stay within my circle of competency, invest in what I know, and invest in the best businesses within the tech industry. Now, not everything is a winner in this growth stock portfolio. If you look at the portfolio here, you will see there are several stocks that have large unrealized losses in this portfolio. I have added all the stocks that have unrealized losses here. The total unrealized loss is 21,900. In comparison, PayPal Holdings unrealized gain of 24,942 is more than enough to offset all these temporary unrealized losses combined. You may notice the stocks that have the largest unrealized losses are all Chinese stocks, including Alibaba, JD.com, Pinduoduo, and Tencent Holdings. I actually made the mistake of buying ARK Innovation and Genomic ETFs when they were near the peak earlier this year. I was fear of missing out. This means I have to hold all these Chinese stocks and ARK ETFs until they recover. Personally, I believe it should take them about 2 to 3 years to recover. The Chinese stocks may take longer to recover depending on when the current Chinese regulatory crackdowns will ease and depending on whether or not Chinese stocks will be delisted from the US Stock Exchange within 3 years by 2024. If the Chinese stocks are forced to be delisted from the US Stock Exchange, my plan is to call my broker and convert these Chinese ADR shares to their HK shares listed on the Hong Kong Stock Exchange. The positive side is that PayPal Holdings unrealized gain of 24,942 is more than enough to offset all the temporary unrealized losses here. Now, to beat the S&P 500 index consistently over time, I always try to look for the best businesses that have increasing earnings and increasing economic modes in the tech sector. For example, if you look at this portfolio, you will see my biggest multi-bagger stocks include Apple, Adobe, Amazon, Alphabet, MasterCard, Mercado Libre, Microsoft, PayPal, Sea Limited, and Visa. You will notice that they are all large cap and mega cap stocks. This is just my personal preference. I don't invest in small cap stocks because they tend to have more risk, especially when interest rates start to increase. I mainly invest in large cap stocks because they tend to have lesser risk and because their businesses tend to be much more established compared with small cap stocks. Again, this is just my personal preference. There's a misconception about large and mega cap stocks. Many people believe they cannot become multi-baggers because of their sizes. It is actually not true. Many large and mega cap stocks can still become multi-baggers because of their increasing earnings, their share buybacks, their product innovations, and their increasing economic modes. Now let's talk about the three major catalysts ahead that could cause the US stock market head to a market correction. I believe the first major catalyst is the upcoming US Federal Reserve tapering. According to this NPR article, the central bank has been buying at least $120 billion worth of treasury and mortgage securities each month. In an effort to support the economy and keep long-term interest rates low, Powell said a formal decision to begin slowing those bond purchases could come as early as the next Fed meeting in November. But the central bank cautioned the pace of the economic recovery remains uncertain. This is from CNBC. The bond purchase have added more than $4 trillion to the Fed's balance sheet, which now stands at $8.5 trillion, about $7 trillion of which is assets bought up through the Fed's quantitative easing programs, according to the central bank's data. The purchase have helped keep interest rates low, provide support to markets that malfunctioned badly at the start of the pandemic crisis, and coincided with a powerful run for the stock market. Powell said the official tapering decision could happen at the November meeting, and the process will commence shortly thereafter. He added that he sees tapering being finished sometime around the middle of next year. Now the US Fed has a dual mandate of maximizing employment and achieving stable prices, meaning to achieve an average 2% inflation rate over time. One of the biggest reasons the S&P 500 has continued to reach new highs is that the US Fed has been expanding its balance sheet, buying billions of US treasuries and government assets every month since the global financial crisis in 2008. If you look at this here from the official Federal Reserve website, you can see the US Fed's balance sheet has increased substantially from less than $1 trillion in 2008 to $8.5 trillion in September 2021. This is a huge increase. The US Fed will eventually need to reduce its balance sheet and its quantitative easing programs. During the same period, you can see the S&P 500 index has continued to reach new record highs. As of now, the US Fed is planning to taper its $120 billion monthly bond purchase program, most likely by the end of the year or early next year. This is to make sure the US economy will not overheat and will not have a high inflation rate of over 2% for a long time. According to the latest data from the US BEA, the US PCE inflation rate is 4.2% at the time of making this video. This is much higher than the US Fed's 2% target inflation rate. The US Fed tapering its $220 billion monthly bond purchase program will help lower the US inflation rate, but it will increase interest rates and borrowing costs for consumers and businesses going forward. It will also decrease the money supply in the US economy, which will impact many businesses that rely on debt to finance their growth. I believe there will likely be two scenarios when the US Fed starts tapering its monthly bond purchase program. If the US Fed tapering causes treasury yields and bond yields to increase substantially, then it will have a huge impact on US stocks because high interest rates also lead to high borrowing costs for businesses. And if the US tapering does not cause treasury yields and bond yields to increase substantially, then I believe US stocks will not be impacted much. I believe the second major risk is that the current high inflation rate in the US may not be temporary. According to this NPR article, Federal Reserve policy makers now think inflation will run hotter than previously expected this year. But the central bank still believes price hikes will moderate in 2022 as pandemic pressures fade. At the conclusion of a two-day policy meeting Wednesday, members of the Fed's rate-setting committee predicted an annual inflation rate of 4.2% by year's end. That's up from 3.4% they were forecasting in June. However, inflation is still expected to cool to about 2.2% next year. Fed Chairman Jerome Powell argues much of the upward pressure on prices is the result of supply chain bottlenecks and shortage resulting from the pandemic. These bottleneck effects have been larger and longer lasting than anticipated. Powell said, while these supply effects are pummeling for now, they will abate, and as they do, inflation is expected to drop back toward a longer run goal. This is from Bloomberg. According to this US Fed dot plot projection here that forecasts future rate increases. The US Fed may increase the interest rate once in 2022 after the US Fed tapering ends. Then the US Fed is expected to increase its interest rate further between 2023 and 2024. Personally, I believe the US Fed to start increasing its interest rate will just be a matter of time, whether it will start in 2022 or later. This is to make sure the US inflation rate will not stay above the 2% target inflation rate persistently for a long period. When interest rates are low, stocks tend to perform much better because businesses can borrow at very low interest rates to finance their growth. But when interest rates are high, stocks will not perform as well because economic growth will slow and because businesses will have to pay higher interest to borrow from banks. This means companies that have a large amount of debt on their balance sheets and that do not generate positive cash flows yet will be impacted the most going forward when the US Fed starts tapering its monthly bond purchase program and starts increasing its interest rate. I believe the third major catalyst is that most US stocks, in my opinion, are still overvalued at the time of making this video. For example, the current Shiller P ratio, also known as the CAPE ratio, is at 38. This is the highest in the past 20 years. The only time the Shiller P ratio was higher was during the dot-com bubble in 2000. The Shiller P ratios measures the S&P 500 companies' P ratio using their average annual earnings over the past 10 years, adjusted for inflation. Personally, I believe many US stocks still have high valuations and are likely overvalued at the time of making this video. For example, I always use this intrinsic value calculator summary to show whether a stock is currently overvalued, fairly valued, or undervalued. The blue bars here represent these US stocks that are likely overvalued if you compare their stock prices with their fair intrinsic values. And the green bars here represent these stocks that are likely undervalued if we compare their stock prices with their fair intrinsic values. When interest rates increase, stock valuations will naturally decrease because investors will demand a high required rate of return to invest in stocks. We will also need to use a higher discount rate to value stocks whenever the US Fed increases its interest rate. When the US Fed starts tapering and starts increasing its interest rate, I believe the overvalued stocks will likely have larger corrections compared with the more undervalued stocks. So what will I be doing going forward? The first thing I would do is to focus on stocks that are likely undervalued going forward, meaning that their stock prices are below their fair intrinsic values. Personally, I believe it's important to only invest in stocks that are outstanding businesses when they are fairly valued or when they are undervalued. For example, if Apple is worth $2.5 trillion based on its future cash flows discounted to the present day, it will only make sense to buy the stock if its market cap is near $2.5 trillion or lower. The second thing I would do is to leave more cash going forward so I can buy more stocks that are outstanding businesses whenever there are large dips in the market. Realistically, no one can predict when the next market correction will happen. For example, the current high US inflation rate may not be temporary. If the current high US inflation rate is lasting much longer than anticipated, the US Fed will start tapering earlier and increasing its interest rate faster, which will cause a larger market correction. There are many other major catalysts such as the US reaching its debt ceiling again, or the Chinese developer Evergrande defaulting on its bond payments, or the Delta variant that is affecting the US stock market. In my opinion, I don't think anyone, including myself, can predict when the next market correction will happen. Instead of getting out of the market altogether, I believe a much better strategy is to stay invested for the long term, go through all the market corrections, and take advantage of them by buying more undervalued stocks that are outstanding businesses when market corrections happen. The third thing I would do is to focus on businesses with strong fundamentals and positive cash flows. When interest rates increase, businesses that have a large amount of debt on their balance sheets and that do not generate positive cash flows yet will be impacted the most. Their stocks will also be impacted the most. In comparison, businesses that are well established with strong fundamentals, strong positive cash flows, and strong economic moats will be impacted the least when interest rates increase. For example, I believe Apple and Microsoft will be impacted the least when interest rates increase because they have strong balance sheets and because they generate very strong free cash flows. This is why I always focus on the best large cap and mega cap stocks that are well established with increasing earnings and increasing economic moats. Now, if you like this video, make sure to smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing analysis videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the stocks I buy for the long term, watch our exclusive investing analysis videos, and download the latest intrinsic value calculators so you will know when a stock is currently overvalued, fairly valued, or undervalued. Thank you for watching this video. This is Victor from the Intelligent Investor channel, and I will see you in the next video.